Hello and welcome back. So in this video I wanted to answer a very popular question that I get asked maybe 2 or 3 times per week, sometimes more often, and it is the question which is the best moving average for your trading. And so I will take a look at a few different moving averages, share my thoughts about moving averages in general, and explain to you how to use them, what are the pros and cons, and so let's get started. So there are 3 different types of moving averages. There is a short-term moving average, which in this example we will use a 7-period moving average. You can see here, once I turn it on, that it moves very close to price here. The 7 is a very fast reacting moving average because it only uses the last 7 periods. Then we have a more medium-term moving average, which is the 21, or in my trading I use the 20-period moving average. You can see this moving average moves much smoother, not as fast. And then we have a medium to long-term moving average, which is the 50-period moving average. You can see here it moves much smoother than the short-term and the medium-term. And of course, then some people use a very long-term moving average. In this example, this is the 100-period moving average. You can see here it was very slow and very different to the other threes. So let's take a look at the medium and the mid-medium. The 50 and the 20-period moving average are still here on the charts, and most commonly used way to use a moving average is to find trend entries and also to determine the trend direction. So here in this example you could see that price is above the moving average here, so traders would be looking for long trades, and then here when price crosses below the moving average they would enter or exit their trades, or even look for trades in the opposite direction. And also one more important thing is that here, when you can see that price is in a range, you can see here that the 2 moving averages more or less move sideways. Of course, the slower period moving average here, the 20, reacts much faster and it drops sideways here already at this point, whereas the 50-period moving average, it moves a little bit slower, and you can see it only goes sideways round about here. And during range markets, the moving averages are not very helpful and they should not be used when the market is in a sideways phase. Okay, so now let's come back to the trend following entries, or the trending phases and moving averages. So you can see here that generally traders look for prices above the moving average to get into a buy trade. And you can see here the 20-period moving average, which is the darker line, moves obviously more faster, and price breaks it above here, and then it stays above the moving average until here. Let me mark that for you. And when we compare to the 50, price stayed above the 50-period moving average until this candle here. So you can see obviously the signal in the 20-period moving average comes much faster, and the 50-period moving average is much slower than the 20. Then let's look at let's just follow price, and you can see here price doesn't enter a downtrend here. Price is below the 20 and the 50, and here price breaks above the 20-period moving average. So a trader who is following the 20-period moving average might have exited that trade because price broke above the moving average, whereas on the 50-period moving average price did not break the moving average until here. So you can see in this first example price stayed above the 20-period moving average longer. The trader would have been able to exit here, whereas on the 50-period moving average the trader would have had a worse exit because price dropped off and then broke the moving average. Whereas when we compare to the second example, here on this downtrend, the 20-period moving average trader would have exited the trade way too early here, and the trader with the 50-period moving average could have ridden the trade or the trend much longer and get more profit. So you can see already how this plays together. The smaller the moving average, the faster the signal. Obviously you will get into trades faster, but you will get also out of trades more faster when there's a sudden retracement. On the other hand, a shorter moving average can also help you get out of trades faster, as we saw here in this example, whereas the signal on the 50-period moving average always comes a little bit later. Here another good example, you can see price broke above the 2 moving averages around here, first above the 20 period moving average obviously, and then above the 50 period moving average. And you can see the 20 period moving average trader would have been able to ride the trade all the way until here, where price then broke below the 20 period moving average. Let me mark that again. So here price broke the 20 period and the 50 period moving average was only broken here. So again, you can see here both would have entered around here for the long trade, and the 20 period moving average trader would have gotten a much higher trade. He would have exited here, whereas the signal on the 50 period moving average came a little bit later and for a worse price. So again, you can see that sometimes the 20 period moving average is better because you get out earlier, but on other times the 50 period moving average is better because it allows you to ride longer trends. And this is really the main point and the main criteria, the main difference between long and short-term moving averages. You need to understand what kind of trader do you want to be. If you are more of a short-term trader or a medium-term trader, then the 20 period moving average and generally lower period moving averages are better for you. But if you want to be more of a swing-term trader, a longer swing-term trader, where you don't mind so much about short-term retracements and you want to catch very long trades or very long trends, then you should go for a more long-term period moving average. And that is really also the answer to it. I know most people, they want to have a specific answer where you get a fixed moving average and people tell you that is the best moving average, but this is not possible, and it depends very much on what type of trader you are, what time frame do you want to be, what is your holding time, and also how fast do you want to get a signal. And so I think the 20 and the 50 are good moving averages. In my own trading, I use the 20 because it's a good compromise between the very short term and the more longer term moving average. So I'll put a few links to my trading course and my trading strategy in the description below, and you can see how I use the 20 period moving average in my trading. And if you have any questions, just leave a comment below.